On the capital side, and David joining the company, look, you're launching this via SPAC. A lot of people look at the SPAC mania right now and think it's a sign of froth or bubbles or over-exuberance. Why do this via SPAC, Jeff?
I mean, the SPAC hype model, it surprised me. I mean, it's pretty new. But I've said this before. When you're in food and energy, you are putting metal into the ground, and these are big balance sheet problems. And like I said, these use cases, they deserve the capital. But the venture capital community is not interested in big balance sheet businesses. It turns out that the big institutional investors are moving their time horizons longer term, and they see these problems that need a solution, and they're there writing checks. Now, it is a fire hose in your mouth if you're a young company that's going public, perhaps before you're ready. But it has this interesting effect where you get your house in order pretty damn fast, and it allows you to attract capital to the balance sheet. I mean, talent to the balance sheet. And David Lee is a perfect example. He would not, I don't think he would be joining Harvest if we weren't public and he didn't see the ability to use a public currency to be first in controlled environment agriculture and to use the privilege given to us by the big balance sheets, the big asset managers, to really make this industry come alive. There's going to be some rough roads. It's not going to be a straight line, but it does bring talent and capital together to solve our biggest problems.
Jeff, stepping away from this particular investment a little bit, when you look across the broader markets, and I mean, SPACs are one example of it, a huge rush there's been, particularly last year and in the final quarter. Do you feel like the broader markets are looking a little bit frothy at the moment?
I do. I mean, it's a retail-driven market more than I've seen. A lot of people have money in the bank and they're at home and they're maybe not going to the horse track. And so that money has probably doubled in terms of its participation in the stock market on a stock-by-stock basis. And that usually is a bad sign.
Shepard Smith here. Thanks for watching CNBC on YouTube.